the weekend was what happened with the Infosys ADR. So let's chat a little bit more about that. And Feroze Azeez joins in on the show right now. Feroze, hi, morning. Good to have you on the show. Feroze, this short squeeze on the Infosys ADR, which led to that jump up of over 50% before trading halted in the counter. A, what explains that? And B, what does it entail for when the stock opens this morning?
Good morning, Aisha. I personally think that like ADRs, like American Deposit Receipts, as people would know it, are instruments where an underlying has to be bought on a working day here, and the custodian keeps that as the custody to issue an ADR, which gets traded. What happens in ADRs is options are there, but futures are not there in ADR. If futures are not there, anybody who is actually selling an option, if he sold an option, if Infosys or any ADR for that matter keeps getting closer to its strike, he needs to hedge it. To hedge it, you have to buy the underlying if you are a short gamma person. So what happens is anywhere where there is very little efficiency to be able to hedge his delta, delta is nothing but a position to be created in the underlying to hedge his option position. So problem is ADRs don't have futures. If people sell an option, if the underlying instrument keeps coming closer to their option, they need to buy this underlying to hedge themselves. So a lot of other algos can create a short squeeze. That's what happened in India, right? Remember, SEBI had actually penalized one of the FIIs, saying that you have been manipulating the market, but it's basically legitimate strategies to squeeze somebody's position using the underlying, and that's what ended up happening. So I personally think that you have to take the end of day closing more seriously than the spike of the 50-55%, which happened. So it closed about 5-6% higher, if I'm not wrong. So ADRs are very inefficient to hedge for a delta hedger, and that's what happened. And that's a short gamma event, which was capitalized by an algo, I guess.
Feroze, do you see, this buyback also, contributing to that, because nearly 90% of the entire ADRs were, tendered as part of the buyback?
Yes, of course. The first one or two fundamental reasons can push an underlying up by 3-5%. The exaggerated move is because of the short gamma. Positions built, and any option trader who's been in the market for long enough, he can understand how much short gamma buildup is there. Coming back, is there a fundamental reason for the stock to move? The answer is yes. What could those be reasons be? I'm not very qualified on a specific stock to comment, but the 5%, for example, the closing move of about 5.8% where it closed, that is more fundamental. The rest of it is derivative technical.
Hi, morning, Feroze.
Hi.
How should one identify a short squeeze, and what are the opportunities available once you have identified them? Are you practically able to take advantage of the opportunity?
Yes, Harsh, it's actually easier to identify. One is you can code it, how to identify. Now, for example, you would see in several weekly expiries of Nifty, the straddle is quoting at very high prices. In certain weeks, it is quoting at very low prices. That is nothing but the algo identifying a potential move and a squeeze on either sides. So is it easy to identify? Yes, it is not as difficult. For somebody who understands Black-Scholes pricing model back of their palm, it is easier to understand. Can you code that in an algorithm? The answer is yes. Why was thousands and thousands of crores being made? Because it's easy to identify. And then what kind of underlying move will create what kind of option gains is also computable. That's why you would lose in the derivative in the cash market to make money in the derivative market. So how does one retail investor identify that? I suspect it's very difficult to identify, because understanding Black-Scholes pricing model is like a 2-year course, which was a Nobel Prize winning formula on the basis of which the pricing of options work. But most people use options for speculative purposes to see can it double if the underlying went up by 100 rupees. So if you actually use it as a hedger, yes. And how to identify? Depending on the delta build-up. Now, SEBI has actually done a very, very good thing, and I think that should be useful. Let me answer this part of the question. Now, SEBI reports the delta position of the options rather than the notional positions. What do I mean by that is 1 lakh Nifty is nothing but 250 crores of notional position. Okay, if 1 lakh Nifty is 2,500 crores of notional position. But if the option is out of the money, the delta value will be abysmal. So earlier we used to count all options on notional. Now SEBI reports delta, which is nothing but the actual sensitivity of the option to the underlying price movement. And I think that's a very good step in the direction. Maybe in a year, 2 years, if somebody were actually understanding the BS model, can use this delta information, which SEBI has started publishing on underlyings.
Feroze, there's one quick question I want to pose to you with regard to IPOs, especially the newer ones coming on stream. We've seen a lot of volatility on some of these names, especially some of that volatility driven by liquidity. But there's also a school of thought, and I'm coming from a perspective that what Nitin Kamath has tweeted, he suggested there are technical factors to this as well. Is it purely a demand supply issue, or are there other nuances that you read in when it comes to some of these IPOs and the volatility some of these shares see?
I think that's a very interesting question. IPOs, it's easier to identify which ones are the ones where you will hold for the short term and which one will you hold on the long term. Second, do I agree with Mr. Kamath? I couldn't agree more. I couldn't agree more at all. These are very easy technical variables. Why is it so? Because the volumes in the initial part of a journey of a stock getting listed are maybe astronomical, even 100 times more than where you will see that stock being in terms of delivery volume a year from now. So when the volumes are very large, demand and supply is in play. If the volume is very low, people are fundamentally buying and holding that stock. That's why the volume is low. So IPOs, is there demand and supply and technical factors driving up and driving down prices? The answer is a big yes. Point two, how do you identify and what is India's behavior with respect to IPO? If you study the last 100 IPOs and on one column you put the total amount of free float stock put in the market, and on the other hand you put the first day's delivery volume, you will see most of the IPOs have a larger delivery volume on first day than the total free float itself. That implies anybody, like for example, if Feroze is buying a stock in India in the form of an IPO, he's not holding it, he's flipping it more often than not. So point is, any IPO for the first 5-7 days is just a money-making short-term game for an Indian retailer. On those days, if you see large institutions picking it up, those are very good signs that the IPO, you should not flip it over a 4-5 day period. Now, if you see some IPOs where some SBI took up 1,000 crore stake in pre-IPO and anchor book, right, where you know that the India's biggest CIO, Mr. Vasan, wants to underwrite almost 2-3% of the stock for long periods of time, and he's not selling. I will be on his side rather than Indian retail side. So IPOs are easier to identify because there's so much information, so much volume, and so much understanding of who's buying in the first few days of it starting to trade.
Feroze, on Friday we saw nearly 5% of ICICI Pru equity getting delivered on the exchanges, and if you look at the total free float, that's around 7%, which basically means if there is more demand coming in from institutions, you're going to see that kind of little volatility in terms of price uptake in ICICI Pru as well going forward.
Yes, so I've not analyzed that specific IPO so far. But if there's a delivery volume almost equal to the free float, you will have to also try and see. That's where there's such large moves which are happening, right? Now, if you see how the behavior of different institutions, which will unfortunately not come till the 10th of the month. So because the fact sheets get released on the month-end fact sheets. So some IPOs which are in the fag end of the month are better equipped to throw you data sooner than later than the beginning of the month. Because I would want to see which are the AMCs actually held on from their anchor book, which were the AMCs actually sold. That's one piece of data which is very, very crucial for you to analyze. So I would not be able to, if I to analyze the stock, I would wait for fact sheets to come. Like, for example, there's one more thing which is not so popular, and quite a few retailers don't even know this, and they will never know. Bloomberg can actually help you download exact shareholding of institutions of any stock, even if they are owning 400 stocks. Now, that's available on Bloomberg. I can just give you a queue. All the top 5 stocks. If you capture what happened a year back, who was owning it, who owns it today, you can see who actually bought during the 1 year period and who sold during the 1 year period. That becomes a very important decision criteria for you to see whether PE expansion will happen or PE contraction.
Yeah, and gives us some good insights as well. Been tracking that. But Feroze, great to have you on the show today. Thank you so much for your time. Let me now welcome on board Chandan Tapadia as well and figure out what he's making of the market right now. Chandan, hi, good morning.